Welcome back. Well, it's a tale of two halves for Firstrand as it delivered a stronger showing in its second half. This further supported its overall annual performance, reporting a 10% rise in net interest income, which boosted earnings coming in 4% higher. This upbeat showing coming despite having to account for a provision from its UK vehicle unit. And joining me now for a closer look at those numbers is company CEO Mary Vilakazi. Thank you so much for your time, Mary. Let's actually start off with the drivers of that operational performance, and particularly the notable improvement in the second half of the financial year.
Thank you, Donati, for having me. And you are correct, it is a tale of two halves, as our earnings were up 6% for the 6 months, for the first 6 months of the year, and the second 6 months of the year actually 14% up year on year. And the strong performance really came from mainly RMB. I think they came through with private equity realization, a lot of structuring and advisory activities. This is on the back of their very strong advances growth. So I think RMB having a really solid performance during this period, and that global markets business also finishing off strong. The other place where our performance we saw coming through was F&B. I think on the cost management side, I think they really have done a good job in making sure that we start monetizing some of the investments in the platforms that we've been making over the last couple of years. And then the third place where that outperformance came from a UK subsidiary. I think the outlook going forward is a bit more positive than last year when they raised a lot of credit provisions. So they've, I think given the expectations of inflation coming down and rates coming down has allowed them to release credit provisions. And then we've had this remediation, a compliance matter to fix in the UK, which with it also came through, I think a boost in terms of reserves that they no longer require. So I think this is a good story of a portfolio effect, because against this backdrop is strain on SA retail franchise, I think with credit impairments up significantly in the year as households and consumers are under pressure. So very good to see operational performance strong. And as you said, it allowed us to absorb a fairly big provision in the UK. So, I mean, after all of that, earnings 4% up, I feel that that's decent outcome given all the headwinds we've had to navigate. And pleasingly, our return on equity at 20.3% within our stated target range, and we are able to declare dividends of 8%. And I guess excluding this provision in the UK, operational performance was really up 10%, and which I really think is a strong performance given where the group operates in.
Yeah. Mary, of course, we know the double-edged sword that comes with a high interest rate environment. You mentioned credit impairments there. Talk to us about the level that you have seen there in terms of your credit impairments, credit losses.
Yeah, so I think across many of the portfolios, of our credit portfolios, I think we've seen resilience. I think, our origination thesis of focusing on low to medium risk customers, I think of being very targeted in certain sectors and customer cohorts. I think overall that thesis has played out. I'll call out retail in particular, because retail, if you look at where we expected repo rates to be, where we expected rates to be at this point in time, I think we have gotten that wrong over the last 3 years. So nobody expected this high level of rates, and I think expected them to be as prolonged as they have been. So under the current, I think macro or cycle perspective, I think if you just look at that, you look at retail performance, as much as it's a steep increase in retail credit impairment, I just think that it's in line with what one can expect in such a cycle. Now, we do expect rates to come down over the next 12 months, so that will provide some relief to households. But I think at the moment we're at about 8.25. Our house view has penciled in about 3 cuts, maybe 2 this year of 25 basis points, another one in the next quarter. The market is pricing in a bit more. Hopefully the market is right with that the 5 cuts coming. But if we get to next year, June, and we've had 3 cuts of 75 basis points, at 7.5%, that repo rate will still be higher than the rates that was that the rate some of the customers were accustomed to pre the pandemic, which was at about 6.75. So we're not calling it I think we're not saying that things are going to be immediately different and better, because I think consumers are still going to be under pressure for a while. And I think it's during this cycle that we are looking towards R&B, our wholesale, corporate business, and commercial, I think, to do more of the heavy lifting as we look forward.
Well, I mean, as we're talking about the credit experience here in the domestic market, I actually also want to scoot over to the UK market there, and particularly as we've had the Bank of England cutting interest rates for the first time in years last month. Have you seen any relief coming through so far, or is it also still maybe too early there to kind of have some relief on the credit experience of Aldermore?
Yeah, and I think that's a very good question, because I think that informs some of our cautious approach. So if we look at activity since rates have come down, I mean, it doesn't, I suppose these things don't just change overnight, but demand for property, which is really what Aldermore focuses largely on, I think has been depressed for a while. Although Aldermore did well to capture, I think, to grow and grow faster than its peers, but I think demand in generally for consumers has been low. I think the real, maybe the bigger unlock is really consumers feeling very confident that inflation has actually come down. So I think there is a winter season story for the UK, perhaps, that still has to run. But I do think consumers need a bit more, I suppose, more comfort that these rates are going to come through, and then that their own affordability has actually improved. So there's probably a bit of a lag effect. And in that asset class, I guess people don't just make their decisions overnight.
Indeed. And we are waiting to see from the Bank of England, to hear from them rather very soon. Thank you so much for your time and for giving us more detail on the numbers that came out from Firstrand. Mary, appreciated. That was the CEO of Firstrand, Mary Vilakazi.